If you understand the balance sheet, you can tell whether a company will make you money or make you lose every dollar you invest in it. So, stay with me until the end of this video because in the next 20 minutes you will learn exactly how to read a balance sheet and use it to spot strong businesses while avoiding dangerous ones. Let's start with the basics. Companies typically publish three main financial reports: the balance sheet, the income statement, and the cash flow statement. The balance sheet is vital because it is a snapshot of a company's financial health on a specific day, usually the last day of the year. A strong balance sheet means the business is healthy and ready to grow. A weak one is a big red flag. If a company has too much debt or too little cash, it could face serious trouble, and investors might lose all their money. One of the best free places to access company balance sheets is the quickfs.net website. I'll search for Google as our example. It is listed under its parent name, Alphabet. Then we have to select Balance Sheet from this menu. Now we can quickly review 10 years of balance sheets. Just remember the reporting convention. If the header says numbers are in millions, then a figure like 23,400 actually means 23.4 billion. That's a lot of cash for Google. A balance sheet is split into three main parts, starting with assets. Assets are simply everything valuable the company owns, anything that can be sold for cash or used to make more money. Just like your house or car are your personal assets, a company's assets include cash in the bank, factory buildings, equipment, and products ready to sell. Next is liabilities, the opposite of assets. Liabilities are everything the company owes to outside parties, like your personal debts, mortgage or credit card bill. A business liabilities include bank loans, money owed to suppliers, and unpaid wages. These are all future obligations that must be settled. Finally, we have shareholders' equity. This is the most crucial part for investors, as it represents the net worth of the company, the value that truly belongs to the owners or the shareholders. Here is the key. If the company suddenly sold all of its assets and used that money to pay off all of its liabilities, the cash that will be left over, that's the shareholders' equity. The beautiful part is that these three things always balance out. It is the foundational rule of accounting. Assets equals liabilities plus shareholders' equity. This equation means that liabilities plus shareholders' equity represents how the assets of a company are financed. Now, let's move on. To get a clearer picture of a company's finances, both the assets, what it owns, and liabilities, what it owes, are split into two groups: current, short-term, and non-current, long-term. Current items involve money that is expected to be received or paid out within about 1 year. In contrast, non-current items are anything long-term, like assets the company plans to keep for over a year, such as buildings, or debts that don't need to be fully paid off for more than a year, like long-term loans. Now let's look at a real balance sheet, Google's, to make this knowledge stick. In the assets section, the first line is cash and cash equivalents. Cash is the literal money in bank accounts. Cash equivalents are ultra-safe, short-term investments, like treasury bills, that can be converted to cash in 90 days or less. They are treated like cash because they are so liquid. Companies hold cash equivalents instead of pure cash to earn a small amount of interest. For huge companies like Alphabet with $23.4 billion in cash in 2024, earning just 1% interest generates about $234 million per year. It is essentially free money for parking their excess cash safely. Next, we have short-term investments. Google has $72.1 billion here. The difference from cash equivalents is simple. Cash equivalents are convertible in 90 days or less, while short-term investments usually cover the rest of the year, 3 months to 1 year. These are still highly liquid and low risk, but they earn a slightly higher return because the company accepts a longer holding period. When analyzing a company's financial strength, many investors like to add these numbers together. So for Google, we have cash and cash equivalents, $23.4 billion, short-term investments, $72.1 billion, so combined $95.5 billion. This combined figure gives you a more clear picture of the company's liquid resources, money they can access relatively quickly, if they need it for acquisitions, paying down debt, or handling unexpected challenges. Moving down, we reach accounts receivable. This is money customers owe the company for products or services already delivered but not yet paid for. For example, when Alphabet sells large ads to a client, the client might have 30 or 60 days to pay. Until that cash comes in, the sale is listed here. Alphabet's balance sheet shows $52.3 billion in accounts receivable, money earned but not yet collected. Watch this number closely. If accounts receivable grows much faster than the company's sales, it is a red flag. It could mean customers are paying slowly or worse, may never pay at all. A financially strong company collects its money quickly. Next up is inventory. This represents all the finished products that are ready to sell but haven't been sold yet. Inventory matters because products sitting unsold tie up cash and cost money to store. The danger sign for investors is when inventory grows much faster than sales. It signals the company can't sell what it's making. For Alphabet Google, inventory shows $0. This makes sense since Google's main business is digital, search, ads, and cloud services. They do sell some hardware like Pixel phones, but those amounts are probably too small to show up separately or are included in other categories. For companies with significant inventory, like a retailer, you want to see that number stable or growing only in line with sales. If it increases rapidly, like the example of a clothing retailer over-ordering products, it forces them to cut prices, which ultimately crashes profit margins. A stable inventory signals strong demand and efficient operations. Next, we see other current assets. This is a small $15.7 billion catch-all category for any short-term assets that don't fit elsewhere. The important thing is that all the current assets we have covered add up to the crucial total current assets, which is $163.7 billion. It represents everything Alphabet can convert into cash within the next 12 months. Now we move into the non-current assets section. These are assets that the company plans to hold for more than 1 year. The first major line here is investments, and Alphabet has $37.9 billion in this category. These are long-term investments and they are different from the short-term ones we just covered. These are typically securities, bonds, or stakes in other companies that the business intends to hold for multiple years. The company parks money here when it doesn't need immediate access to it, allowing the capital to generate higher long-term returns. Next, we have property, plant, and equipment, which stands at $184.6 billion. This represents all the long-term physical assets the company owns, buildings, equipment, and land. For Alphabet Google, this massive figure primarily covers all their global network of data centers and all the servers that power Search, YouTube, and Google Cloud. This amount reveals how capital-intensive the core business is. Alphabet must constantly invest huge sums to build and maintain the massive computing infrastructure needed for its services to run and grow. Next, we see Goodwill, and Alphabet has $31.8 billion in this category. Goodwill is not a physical asset. It arises when one company buys another company for more than the fair market value of its tangible assets, like buildings, equipment, and inventory, minus its liabilities. Essentially, it represents the intangible value of the acquired business, such as its brand reputation, customer base, or proprietary technology. Warren Buffett famously calls these things soft assets. For Alphabet, this amount primarily comes from past major acquisitions. While it is listed as an asset, it can be written down if the acquired business fails to perform, resulting in a loss for the company. Other intangible assets. This shows 0 for Alphabet. Intangible assets are non-physical items like patents, trademarks, and copyrights that a company has purchased. Finally, we have other assets, which totals $32 billion for Alphabet. This is another catch-all category, but for non-current items, assets the company expects to hold for more than a year that don't fit into the other categories we have discussed. This could include things like long-term prepaid expenses, deferred tax assets, or various other long-term financial instruments. When we add everything up, we get total assets of $450.2 billion. This represents everything Alphabet owns, from cash and investments to buildings and equipment. But here is the key question. How is this financed? That's where liabilities come in, everything the company owes. First is accounts payable at $7.9 billion. This is money Alphabet owes suppliers for services and resources already received. For example, when Google purchases server hardware for their data centers or pays for marketing services, they don't pay immediately. The supplier sends an invoice with payment terms like due in 60 days. During that time, the amount sits as accounts payable, a bill they will pay soon, but the cash stays in their account temporarily. Next is tax payable at $2.9 billion. This represents tax obligations due within the next 12 months. Accrued liabilities shows $48.9 billion for Alphabet. Accrued liabilities are expenses the company has incurred but hasn't been billed for yet. For example, Google employees worked the last week of December and earned wages, but payday isn't until January. That unpaid wage expense is an accrued liability. Short-term debt shows zero for Google. This means Google has no borrowed money due within the next 12 months. Current portion of capital leases is $2.8 billion, which is lease payments Google owes this year for things like office buildings and equipment they are renting long-term. Deferred revenue shows $5 billion for Alphabet. This is money Google has already received from customers but hasn't earned yet. For example, when a business pays Google upfront for a year of Google Workspace subscriptions or cloud services, Google gets the cash immediately but can only recognize it as revenue month by month as they deliver the service. High deferred revenue is actually a positive sign. It means customers are paying upfront, providing immediate cash flow and indicating strong demand for Google services. Other current liabilities totals $21.3 billion. This is a catch-all category for any short-term obligations that don't fit into the specific categories we have covered. When we add up all these current liabilities, accounts payable, taxes, short-term debt, deferred revenue, and others, we get total current liabilities of $89.1 billion. This represents everything Alphabet must pay or fulfill within the next 12 months. Now let's go to the non-current liabilities, obligations due beyond the next 12 months. Long-term debt shows $10.8 billion for Alphabet. This is money borrowed that they don't have to pay back for more than a year, typically through corporate bonds. Companies use this debt to fund large projects like building data centers. For a company like Google, $10.8 billion is very small. They could pay off every dollar of this debt instantly using their existing cash, demonstrating a highly conservative financial position. Capital leases shows $11.6 billion for Alphabet. This is the long-term portion of those lease obligations. Payments due beyond the next year for office buildings, data centers, and equipment Google is renting under long-term agreements. Deferred revenue is money paid by a customer for a service the company owes them later. In the non-current liabilities section, this means the service is owed more than a year from now. Since most of Google's contracts are short-term, under 1 year, you'll often see this long-term amount is zero. Other liabilities totals $13.4 billion for Alphabet. This is a catch-all for long-term obligations that don't fit into other categories, things like pension obligations, long-term tax liabilities, or other commitments due beyond 1 year. When we add up all the current and non-current liabilities, we get total liabilities of $125.1 billion. This represents everything Google owes to external parties. To complete the final and most important section for investors, shareholders' equity, we must apply the foundational rule of accounting we saw earlier, the balance sheet equation. This equation ensures that a company's resources are always equal to the claims against those resources. Assets is equal to liabilities plus shareholders' equity. To find the actual value that belongs to the owners, the shareholders, we simply rearrange the equation to isolate shareholders' equity. Shareholders' equity is equal to total assets minus total liabilities. Shareholders' equity is the company's net worth. It is the value that truly belongs to the owners, their shareholders. Think of it like selling your house. The assets are the price you sell the house for. The liabilities are the mortgage you have to pay off. The shareholders' equity is the cash left over for you after the mortgage is paid. This equity figure tells you what share of the company's total value remains after all its debts and obligations have been covered. It's the ultimate measure of the investor's stake in the business. So if we do the math on Alphabet's numbers, the resulting figure, $325 billion, is Alphabet's total shareholders' equity. And if we check at the balance sheet, the same number is right here. But we derived it ourselves. Don't you feel more confident now in your understanding of the balance sheet? Okay, so now that we have walked through the entire balance sheet and understand what all those numbers means, how do we actually determine if this is a financially stable company? We do that by turning those static numbers into dynamic tools. And one of the most popular calculations investors use is the current ratio. This ratio gives us a quick, clear answer to a fundamental question. Can the company pay its short-term bills? The current ratio is calculated by taking all the money and assets a company can convert into cash within 1 year, total current assets in other words, and dividing it by all the bills it has to pay within that same year, total current liabilities. We take the numbers we found for Alphabet. Current ratio is equal to 163.7 over 89.1 equals 1.83. What this means? A current ratio of 1 or greater is generally ideal, showing the company has enough quick assets to cover its next year of bills. So we can answer the essential question: can the company pay its bills? This 1.83 ratio indicates a highly conservative and liquid financial strategy. For every dollar of short-term bills due in the next year, Google has $1.83 in quick cash assets to cover them. It is doing great, but a company's balance sheet is only a snapshot of its financial position at one moment in time. To understand the full picture, we need to look at multiple years to see if the company is getting financially stronger or weaker over time. That's why sites like quickfs.net are valuable. They give us 10 years of historical data for free. When investing, we want to see if the company's total current assets, cash position, and other key numbers have been growing consistently over the years. We are looking for a pattern of getting stronger, not weaker. Let's look at Alphabet over the last 10 years. Their cash position grew from $62 billion in 2014 to over $95 billion today. Total assets exploded from $129 billion to $450 billion. This shows consistent financial strengthening. Now their liabilities also grew from $25.3 billion to $125.1 billion. Is that bad? Not if assets are also growing, which they are. This is where judgment matters. If liabilities rise while assets fall, the business is failing. But if both rise together, the company is successfully using leverage to fund growth. For Alphabet, massive asset growth easily covers the rising liabilities. They are moving in the right direction. Now let's look at shareholders' equity, the true measure of shareholder value. It grew from $103 billion to $325 billion over the decade. This is the critical number. Shareholders' equity should ideally increase every year. When it declines, it means the company is taking on more liabilities than it is creating in assets. A red flag. Alphabet's equity more than tripling over 10 years is the classic sign of a healthy, growing company. Despite rising liabilities, they are building real shareholder value. This strong balance sheet makes Alphabet worth investigating further. Remember, the balance sheet is just your first filter. It is a quick check to weed out companies with obvious financial problems, too much debt, declining equity, or cash shortages. If a company fails this test, it is smarter to move on and focus your research time on stronger candidates. That's our balance sheet analysis. I know it was detailed, but understanding these lines gives you a powerful tool for evaluating any company's financial foundation. However, the balance sheet is only one piece of the puzzle. To see if the company is actually generating real cash and spending it wisely, you need to analyze the cash flow statement, which I cover in this video. Click here to watch it. If this video helped you, please like it and subscribe to the channel so you don't miss any future video. Thanks for watching.